right? But why does it become a support level? So as the price of an asset moves towards the downside, puts start becoming, so especially puts that were previously out of the money, start becoming at the money or in the money. So they start actually having value. So investors that really had been buying those options for protections as a hedge to the downside are going to then change their positioning. So they're either going to monetize those options or they're going to roll those options to the downside depending on the sentiment. But why does this level become a support? So the put support level is a level where there is more put hedging activity. So the market maker is usually shorting when we touch that level. And as the spot get closer to those puts, those puts actually go into the money, right? So they start monetizing, becoming profitable. So as an investor, imagine if you're holding those puts, and obviously those puts have an expiration, you are either going to do two things. If you really believe that the price can go actually much lower, you might keep those puts, and those puts can increase in value, or most likely you're going to monetize those puts. So you might sell those puts and maybe, buying lower strike prices, more out of the money puts. So you're basically closing those options contracts. So let's imagine that we're monetizing those puts. That can give the market a technical upside, as the market makers that were now shorting those underlying or based on the delta of those options are now closing their hedges because they don't need to hedge those positions anymore, right? So by closing those short positions, they are going long on the other side, and that's when you see those technical move and those reactions close to the put support. So if the investor is closing the put, the market makers does not have to stay in the short to hedge the put anymore, and they can now adjust their delta, and that can bring the market to the upside. Here we have an example. Yesterday, I think it was on NQ, where the price reaches the put support 0 DTEs in a couple of times. And as we can see, basically, it doesn't break through that level. And then we see like a change in trend and a massive upside in a couple of occasions there. All right. The other way of trading the put support, similar to what we've seen with the core resistance, is by using it as an inflection point for an accelerated downside. This typically happens when we see a strong bearish sentiment in the market, and investors are actually not closing those positions, but they're actually rolling it to the downside. So basically, they buy more out of the money puts to protect their exposure at lower strike prices. Now, if those hedges are open lower, that can push the put support level towards a lower strike and could become another bearish force as the market makers need to then hedge those puts as well.